Good morning. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled The Next Phase of Financial Regulatory Reform, What's Ahead for Non-Bank Financial Companies. My name is Larry Platt, and I'm a partner in Mayor Brown's Washington, D.C. office and a member of the Financial Services Regulatory and Enforcement Practice. I concentrate my practice on a range of matters related to real estate finance, mortgage banking, and consumer finance in both the primary and secondary markets. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to GFM, Gary Frank Mark, GFM@mayorbrown.com, and we will respond promptly. This is the same email address on your invitation email. So joining me today is Andrew Olmem. Andrew is a partner in our Washington, D.C. office and a member of the Public Policy, Regulatory, and Political Law practice at our firm. Prior to joining Mayor Brown, he served as the Deputy Assistant to the President for Economic Policy and Deputy Director of the U.S. National Economic Council, where he oversaw the development and coordination of all domestic economic policies, including for financial services, technology, telecom, energy, and infrastructure. With those brief introductions, we'll now begin today's discussion, and I turn it over to my partner, Andrew.
Thanks, Larry. Today, I'm going to discuss the prospects that the Financial Stability Oversight Council, known as the FSOC, will take actions under the leadership of its incoming Treasury Secretary Janet Yellen, to reform the regulatory framework for non-bank mortgage companies. Over the last year, financial regulators have increasingly focused on examining the regulation and supervision of non-bank financial companies. The Financial Stability Board and the Securities and Exchange Commission have each issued reports on the performance of the U.S. financial system during the COVID economic shock last year. Each report identified weaknesses in the business models and regulation of certain non-bank financial companies, including non-bank mortgage companies and servicers, and suggested that financial regulators examine how regulatory reforms could improve their resilience and reduce the risks they present to financial stability. Last October, current FSB Chair and Federal Reserve Vice Chair for Supervision, Randall Quarles, gave a major speech in which he echoed these conclusions. In its 2020 annual report, the FSOC also noted that the non-bank mortgage companies were subject to, and I quote, certain fragilities such as heavy reliance on short-term funding, obligations to continue to make servicing advances for certain delinquent borrowers, and limited resources to absorb adverse economic shocks, end quote. The report recommended that state and federal regulators strengthen oversight of non-bank mortgage originators, but declined to provide specific policy recommendations. Thus, even before the presidential election, U.S. financial regulators and the FSOC were beginning to turn their attention to strengthening the regulation of non-bank mortgage companies. The election of Joe Biden as the next president of the United States and his selection of former Fed Chair Janet Yellen to serve as Treasury Secretary will only likely accelerate and intensify the efforts of federal financial regulators to pursue regulatory reforms for non-bank mortgage companies. Yellen has clearly stated that she intends to reinvigorate the FSOC and supports providing it with additional authorities over non-bank financial companies. Her position is not surprising. Indeed, the regulation of non-bank financial companies could be viewed as the logical next phase of the reform process initiated by the Dodd-Frank Act. From this perspective, phase one of that reform was enhancing regulation of banking organizations. That work was largely completed by the Obama administration. As a result, the Biden administration could be viewed as picking up the reform process where it ended with the Obama administration and now turning to enhancing the regulation of non-bank financial companies. The Dodd-Frank Act created the FSOC specifically to allow federal regulators to oversee and potentially regulate non-bank financial companies. The FSOC is a unique body in our financial regulatory structure, so it's worth reviewing how it works. The FSOC has 10 voting members, consisting of the agency head for each of the financial regulators, plus one independent member who must have insurance expertise. The FSOC's responsibility under the Dodd-Frank Act is to monitor for risk to the financial stability of the United States. In the wake of the 2008 financial crisis, it was clear that the U.S. financial regulatory regime had become too siloed. Each regulator was focused on risks presented to the entities under their jurisdiction. No regulator was responsible for monitoring risks that might impact the entire financial system. To address this problem, the FSOC was created as a means to ensure that financial regulators met regularly to discuss systemic risks, particularly where gaps in regulation created systemic risks. To ensure that the FSOC has the capacity to properly identify and assess systemic risks, the Dodd-Frank authorized the FSOC's research arm, the Office of Financial Research, to collect information from financial companies. To the extent that the FSOC identifies potential risks to financial stability, the FSOC has several tools. First, it can make recommendations to other agencies to take actions to address those risks. Any recommendation by the FSOC is likely to be taken very seriously by financial regulators. Second, the FSOC can also make recommendations to Congress for new regulatory authorities to address those risks. While Congress is not required to act on them, any such recommendations would likely get significant attention by members of Congress. Finally, and most importantly, the FSOC has the ability to designate financial companies for heightened prudential supervision by the Federal Reserve. During the Obama administration, the FSOC used this authority to designate several companies, including MetLife, Prudential, and AIG. Any company designated for heightened prudential standards would become subject to new capital and liquidity regulation, resolution planning, and a series of other prudential regulatory restrictions. The process for designation was recently modified by the FSOC to create a two-step process whereby FSOC first determines whether any systemic risk presented by the company can be addressed through regulation of any systemic activities that the company engages in and that create the company's systemic risk. If so, the FSOC will seek to have the appropriate regulator regulate the activity for the entire market in a manner that addresses the systemic risk. This is known as the activities-based approach. If the activities-based approach fails to address a company's systemic risk, then the FSOC would move to determining whether to designate the company. The FSOC has published extensive guidance that lays out the specific risks that merit designation of a company. These risks include whether the company engages in asset liability transformation in a manner that makes the company vulnerable to bank-like runs, whether the company has a significant securities portfolio such that if the company experienced material financial distress, it would have to sell the portfolio in a fire sale, which could reduce the value of securities in the marketplace broadly and thereby cause other companies to experience financial distress. And finally, whether the company is so interconnected with the financial system that its failure could cause the failure of other firms. It's important to note that many influential experts on systemic risk regulation believe that the FSOC should be focused not only on large companies. Rather, they contend that the FSOC should consider designating even mid-tier sized firms on grounds that collectively they can present the same systemic risks as large companies. Hence, one cannot assume that going forward, the FSOC will only be considering designations of the largest firms. Now, returning back to the Biden administration's priorities, whether Yellen will actually move to quickly designate a number of companies is unclear at this point. It's also unclear whether mortgage companies will be the initial focus. The FSB and the SEC reports I mentioned earlier also identified a range of non-bank companies for further regulatory scrutiny, including broker-dealers, money market funds, certain investment companies, as well as non-bank mortgage companies and servicers. Accordingly, it is unclear where non-bank financial companies will fall on the FSOC list of priorities under Yellen. However, it is clear that given the FSB and SEC reports, the FSOC's annual report, and the intent behind the creation of the FSOC under Dodd-Frank, the grounds have been laid for the FSOC to undertake an examination of the regulation of non-bank mortgage companies and servicers. If the FSOC decides to act, it could take several steps that could impact the industry. First, it could begin by requesting information from non-bank mortgage companies to help it assess which companies present the greatest systemic risks, and also to learn simply more about the market. Second, it could initiate an activities-based review to determine if additional regulation is needed to effectively address any systemic activities engaged in by non-bank mortgage companies. This could result in recommendations to other regulators, such as the Federal Housing Finance Agency, and to state regulators. In Larry's remarks, he will discuss further the potential reforms the FHFA and state regulators are already considering. The FSOC could also designate non-bank mortgage companies. The types of companies most likely to be considered for FSOC designation include companies that rely on short-term financing, such as repos, have significant portfolios, and or are highly interconnected with other financial companies, especially if they are owned by large asset managers or hedge funds. Now, any company that the FSOC considers for designation has due process rights to a hearing by the FSOC in which the company can present its case on why designation is inappropriate. And it also has the opportunity to undertake reforms to reduce its systemic risk profile. Companies designated would also have the ability to seek judicial review. When MetLife was designated by the FSOC, it ultimately sought judicial review, and its designation was overturned by the courts. That said, contesting an FSOC designation is a time-consuming and complicated proposition. Given the prospect of FSOC action that could impact non-bank mortgage companies, it will be critical for companies to closely watch the FSOC in the coming months. For companies that believe they could find themselves being considered for designation, it is appropriate to begin an internal assessment of their operations to fully understand whether they satisfy FSOC's standards for designation and whether any mitigating factors or changes in operations could reduce those risks of a designation. It is always good to be prepared. With that, I want to turn it over to Larry, who will discuss further the prospects of regulation at the state level and by FHFA.
Thanks, Andrew. So I'm going to talk about the same issue in the context of residential mortgage servicers. As Andrew noted, FSOC has encouraged state regulators to work to develop prudential and corporate governance standards for non-bank mortgage servicers. Taking a cue from that, on September 29th last year, the Conference of State Bank Supervisors, which is an organization made up of state regulators, released its proposed prudential standards for state oversight of non-bank mortgage servicers. Comments were due by the end of last year, and they did receive many comments. So one thing to keep in mind is that this Conference of State Bank Supervisors, CSBS, doesn't have any regulatory authority to require mortgage servicers to follow these standards. It's not creating law or regulations. Instead, what it does is suggest the state regulators to adopt the standards, and it's up to the states to figure out how they do that. In some cases, it might be new legislation, it might be regulations under existing statutory authority, or it might just be guidelines that they come out with. And I want to say that that's one of the most important concerns that the industry has about this proposal, that it could be incorporated or implemented 50 different ways, both in terms of the terms of the standards, if they're ever finalized, but also how they're interpreted and enforced. So you could have a situation where one state that narrowly interprets its particular provision could terminate the license of a servicer and having a ripple effect and actually causing the very risk to the system that these standards are designed to prevent. So as a threshold matter, the fact that at least this proposal would not be uniformly implemented or interpreted is a big concern. So this isn't the first effort of CSBS to apply prudential or safety and soundness standards, even though it's been taking the cue from FSOC. They did come up with some proposed prudential standards for non-bank servicers back in 2015, but that didn't really go anywhere. But I think more importantly, states loosely have monitored non-bank servicers over the last several years from both a financial strength and a governance perspective. They didn't have any standards per se. They were just watching and asking. But nevertheless, presently, there's no uniform or comprehensive prudential standards that apply to mortgage servicers, non-bank mortgage servicers. And that's not really surprising since, unlike federally insured depository institutions, non-bank servicers don't hold federally insured customer deposits, so there's not the same risk to the taxpayer. So what changed? Aside from just the cue from FSOC, why do they care? And in the proposal, the CSPS pointed to a a changed non-bank mortgage market is the driver of their standards, and it emphasized that non-bank mortgage servicers presently service roughly 40% of the total single-family residential mortgage market, and it expressed concern about the rapid growth of non-banks in this sector. But what it didn't mention is that third-party agency servicing, Fannie, Freddie, and Ginnie, presently comprise over 75% of the non-bank third-party servicing market, 75%. And those agencies have very comprehensive financial strength requirements, so it does call into question the real purpose. And it also didn't mention that the private investors on whose behalf non-bank mortgage servicers administer non-agency loans have their own requirements as counterparties to the servicing agreements. And so in any event, it doesn't seem that on its face an increase in market share necessarily means a corresponding increase in systemic risk. So according to the CSBS, the proposal aims in part to provide protection for borrowers, as you would expect, but also protection to investors and other stakeholders. Now, that's an interesting position from a state mortgage banking regulator. Protecting borrowers, fine, but protecting investors and other stakeholders? I've never really seen a state mortgage banking regulator looking out for the investors in a privately owned mortgage company. But maybe this relates interconnectedness element that Andrew discussed. But against what are they protecting them? You know, if we're talking about FSOC, remember we're talking about systemic impact on the U.S. financial markets, which it's hard to believe that all these servicers could have that impact. But basically what they've done is they borrowed a standard from the safety and soundness standards to which federally insured depository institutions are subject. So what is a safe, an unsafe, and unsound practice? Well, the widely cited meeting in the banking context is an action or a lack of action that, if it continued, would be abnormal risk or loss or damage to an institution, its shareholders, or the agencies administering the insurance funds. But it doesn't talk about systemic risk to the markets. It talks about loss or damage to the institution itself, shareholders, or the agencies administering the insurance funds. Ironically, it doesn't even mention consumers, although presumably that's part of the purpose. And as I said, there's no federal insurance funds at risk in this case. And again, why should protection of shareholders of a non-bank mortgage servicer be a goal of state mortgage banking regulators? I don't really understand it. So let's go to the specifics of the proposal. The most complicated, or I would say controversial, part of the standards are the financial strength requirements, and these relate to net worth, capital, and liquidity. So it's three separate financial strength requirements: net worth, capital, and liquidity. And you'll see that they're tied to the Fannie Freddie standards administered by FHFA as the conservator or regulator of those two. So with respect to minimum net worth, the proposal requires non-bank servicers to maintain the higher of $2.5 million of base net worth plus 25 basis points of owned unpaid principal balance of residential mortgage servicing, or the FHA eligibility requirements. So even though it's linked to the FHFA eligibility requirements, it's the higher of. So if FHFA reduces its requirements down the road, even though that's the principal risk is the issues related to servicing for the agencies, the states could impose a higher one automatically. So this is consistent with the existing GSE requirements. Last year, FHFA proposed enhanced financial strength requirements in January. They rescinded them in June, and it's perceived to be that it was rescinded because FHFA thought even more enhanced standards might be required given COVID. But in any event, the proposal originally provided for an extra, a larger basis point configuration for Ginnie Mae servicing, and that's not in the state proposal. They did ask, the CSBS asked whether owned whole loans should be included in this. So if a servicer is servicing its own loans, should that be included in the calculation? Subservicers aren't included for part of the test on net worth. They have the $2.5 million requirement, but not the overlay of X number of basis points times their balances of the loans. So that's net worth. With respect to capital, it's pretty straightforward. It's the higher of test, 6% of the net worth, or FHA eligibility requirements. And then the third is liquidity. And again, it tracks FHA requirements, in part though. Under the proposal, non-bank servicers would be required to maintain liquidity at an amount that's the higher of. So in all three cases, they have this higher of test. 3.5 basis points of agency servicing unpaid principal balance plus non-agency unpaid principal balance, or the FHFA eligibility requirements. So this is materially different than the agency requirements because the agency liquidity doesn't include non-agency unpaid principal balance. FHFA last year proposed to increase that from 3.5 basis points to 4 with an additional amount for Ginnie, but as I said, that was rescinded in June. But then, like FHFA, there are additional requirements on the liquidity side for non-performing loans. And here it's pretty high. It's 200 basis points times the principal balance of the non-performing loans for the portion of the agency and non-agency loans greater than 6%. In other words, if you have a greater than 6% delinquency, then there's an additional liquidity requirement of 200 basis points times the loans in excess of 6%. So again, the agency requirements don't include non-agency balances for that purpose. And the FHFA actually discounted the balances on COVID-related loans. Last year, FHFA proposed to reduce that from 6% to 4% and increase it from 200 basis points to 300 basis points. So if that were to go through, that would automatically supersede the state level because it's the higher of. So an obvious question there is, why is this level of liquidity needed without regard to whether the servicer is subject to advance requirements? Clearly they are on the agency side, but on the non-agency side, they may very well not have advance requirements, particularly on whole loans, whole loan servicing where P&I advances are not that customary. The proposal also goes beyond the agencies in adding an additional liquidity test, which is really an operating liquidity test. They have to maintain sufficient allowable assets to cover normal operating expenses in addition, but it doesn't detail how that would be calculated, and it would defer to the board of directors to come up with that. Now, the interesting, really controversial part of this liquidity test is that it would exclude from allowable assets unused available portions of lines of credit, which these days is what servicers principally are using, their advance lines, to meet their advance requirements for agency servicing. Fannie and Freddie also just changed their requirements to delete those advance lines as well, and so that's a big concern for the industry. CSBS indicated that it thought that by leveraging the FHFA requirements, it could lessen the regulatory burden on non-bank mortgage servicers. And that's true in part to the extent it's the same as the agency requirements. But first, what's the point of the higher construct? And second, what if you're not an agency-approved servicer? Why do you need those same levels? Now, what they also did is provide a higher test for so-called complex servicers. And those are servicers that have MSR portfolios in excess of $100 billion, or representing at least 2.5% of the total market share. Now, it doesn't prescribe the calculation of enhanced financial strength requirements. Rather, the servicers have to basically work with their board to develop a methodology to determine and monitor its capital and liquidity needs. So some of the concerns related to these financial strength requirements, an obvious one is that the GSE requirements aren't regulatory in nature and can be waived or modified. What does it mean when the standards are embedded in regulation? Can the regulator waive it, for example? Can it just come up with an action plan? the one-size-fits-all approach doesn't really work when there's different obligations of servicers based on the servicing agreements. There's a concern about impact on loan origination, such as a disincentive to stretch given the enhanced liquidity requirements if the loans go delinquent. And then there's the impact just on small business. Can small servicers really survive these charges? So that's the financial strength requirements. I'll quickly go through the other ones that are here. The next is a risk management requirement where, like banks, a non-bank servicer would be required to establish a risk management program under the oversight of the entity's board of directors. Now, that's already true in existing regs for a compliance management system, but here, the risk management program would also include credit risk, liquidity risk, operational risk, market risk, compliance risk, and reputational risk. So just kind of interested to see how a state regulator is going to look at things like reputational risk or market risk and whether the servicers have properly taken that into account. Third component is data requirements, and all that basically says is that you have to follow RESPA's Regulation X requirements on servicers to maintain documents. I don't know why you need that, except that small servicers are excluded from that requirement under the CFPB. Fourth requirement is data protection. Okay, so they have to protect data. They have to have controls related to the governance of information technology, perform risk assessments and testing and monitoring. Fine, not a lot of controversy there. The fifth is corporate governance. So there, the servicers are obligated to establish a corporate governance framework that protects the interests of the servicer, fine, and the servicer stakeholders. Again, why are state mortgage banking regulators getting into the interests of servicer stakeholders? The sixth requirement is on servicing transfers, and it's really hard to figure out how this fits into prudential standards. It's really just incorporating the CFPB rules on servicing transfers. So I don't know why they're putting it here. The last one is change of ownership and control requirements where non-bank servicers would be required to provide advance notice of a change in ownership of 10% or more of a mortgage servicer. Now, why that's in here? Most states have change of control requirements already. And in fact, there are many that are much more onerous than this. So it's not really clear what's there. So there's, as you can tell, lots of pushback in the comments. And I think if you wanted to see a really comprehensive response, look at the Mortgage Bankers Association comment letter. So with that, I'm going to go back to the closing remarks and just say thanks for tuning in. A couple of brief reminders. Remember, you'll receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. And last, as I previously mentioned, if you have any questions related to today's content, please email them to GFM, it's Global Financial Markets, @Mayor Brown. And thank you again for your participation, and you may all now disconnect.